this week sees the major high cap and tech stocks reporting their earnings. So expect the market to get whiplash all week long as it tries to sort out the beats and the misses and the near misses and the all-important guidance, because whether we're going to have a soft landing, a hard landing, or no landing at all is what everybody cares about right now. So here's my prediction. Well, in 1 second, I'll give you my prediction, because first I want to let you know this is Randy Kirk. This is Randy Kirk, and I would like you to like this content if you enjoy getting these Sunday night updates on what's going to be coming up in the future week. And I would like you to subscribe and hit notify, and then of course join my Patreon, because I could use the support for the channel. Okay, now let's jump right into my prediction. I don't want to bury the lead. After ups and downs and billions of words written about earnings this week, the market will end the week just about where it started. Some of these companies will miss, some of these companies will beat, but when I report on Good News Friday, because you know I do another show like this on Friday night, when I report that, the investing community will still be completely confused about the future of the US economy and the world economy for that matter, but much more emphasis on the US economy. So who's going to be reporting this week? Well, just name the big high-tech company: Alphabet, Microsoft, Amazon, Meta, General Motors, and so many others will make headlines this week. I'll be happy to go through that list, and I'll give you my estimates of what I think each and every one of those is going to do this week. But you might as well pull out a dartboard and throw darts. I think you'll get a way better guess than I could possibly give you on these. So my prediction is chaos. Now, when I say chaos, not chaos in a bad way, not even chaos in a good way, but rather just chaos, meaning it'll be all over the place, because each of these companies has their own circumstances right now. And as they give their expectations about how the year is going to play out, that is going to be the part that you want to look at the most carefully. And check it out this week, and good luck figuring out what the overall picture is by the end of the week. I'll give you my analysis at the end of the week, and it'll be as worth as much as maybe your analysis would be, but it will be one more thing for you to bring into your world to kind of guess where things are going. All right. The reporting this week includes some more housing reports. I want to say to those who are not regularly on my channel, and I'm sorry for those of you who are, I'm just going to repeat this again. The housing market is not going to act the same way as it normally does in a tough or recessionary or whatever market. It has already gone down some, and it went down for a very specific reason. It went down because mortgage rates went up, kind of like the Tesla situation, where Tesla needs to lower their prices, in fact, by about the same amount, 15 to 20%, because the interest rates went up and it created an affordability issue. It's almost exactly the same situation. It didn't go down because there's plenty of supply in the case of housing. It went down because people couldn't afford the prices that were out there at that given time. However, it's not going to go down much more. And every evidence of that so far, every reporting so far this year is that prices are not going down more. And why is that? Because there's no inventory. Last week's reporting showed that there was 20% less inventory on the market this year than there was last year, and less than there was pre-pandemic. And all of those have been historic lows. So now we're at historic lows. It's just crazy. So unless mortgage rates go up substantially, you're not going to see further deterioration in residential housing prices. Now, on the other side of the coin, as I've been reporting for a few weeks now, leases, rentals, those have been going down a little bit. And the reason they're going down is because there's been a lot of building in that category. So that could be really helpful to the Fed. Of course, all this reporting that we're talking about is all about good news, bad news. So, if we have lots of great news with regard to earnings this week from these mega techs, then is that good news for the market, or is that bad news because it means interest rates might go up? If we have really bad news from those tech reportings, will that be good news because it'll help the Fed, or will it be bad news because we're going into a recession? This is part of the confusion that everybody's dealing with right now. And it's the same with the reports that are coming up this week. So here we go. What are the reports? Besides housing reports, a couple of housing reports in Tuesday and Wednesday. And then we get into I'm sorry, let's see, I'm gonna have to scroll down here just a little bit. So Thursday, we get the GDP for the first quarter. So once again, same question. If GDP is around 1.8, which the street thinks it will be, and that compares to fourth quarter at 2.6, normally that would be something that would kill the market in a regular bull, nice market. It would kill the market. The market would say, oh my gosh, we're in real trouble now. But this is what the Fed wants. The Fed wants the world to slow down. It wants the United States to slow down. And so a 1.8 could be considered something good. So we'll see. Now, if it's 1%, or it's 0.5%, or it's flat, that will have all kinds of other implications. I haven't studied it enough to be able to tell you with any certainty at all what I think will happen with regard to the GDP for the first quarter. Just to say 1.8 is what the street is saying. So therefore, ups or downs, obviously, if it's way over 1.8, that will hurt the market badly. You can count on that. All right. On Friday, we get the all-important CPE, which is the personal, did I say that right? The Personal Consumption Expenditures Price Index. The Consumption Expenditures Price, I don't know. It's so long, I can't even spell it all right. Okay, so it's called the CPE though, and it is the most important inflation indicator for the Fed. This is based on consumption as opposed to a basket of goods. So your regular CPI is a basket of goods. They analyze this basket and they make certain conclusions over whether prices are going up or down. The CPE on the other side is based on what people are actually consuming at this time on a more real basis, on a more month-by-month basis. All right, so here we have the expectation being about 4% year over year, which I'm sorry, 4.5% year over year compared to 4.6 last month, only a 0.1% decline. I don't think the market will like that if that's true. If it's down around 4%, I mean, down around 4% or less than 4%, then I think the market will love that. If it's over 4.5, 4.6, if it's something up closer to 5, the market will hate it. You can expect, the market to react to something like that. All right, let's switch our attention to Tesla. No big announcements that we know of expected this week. But Tesla did show just over the end of last week, they did show they can raise prices as well as lowering them. So they raised the prices on Model S's and Model X's in the United States by a couple $1,000s. Expect this to continue. Expect Tesla to be modifying prices by territory, by car, all the time. This is going to be the new reality. It's going to get to the point where it's just going to be normal. And so you'll see, it'll get to the point where nobody's even paying attention to it anymore, except people that are interested in buying. You don't pay any attention to whether the Sheraton is lowering the prices on their hotel rooms or raising them in their hotel rooms on a week-by-week basis, do you? No, it's not a headline, but they're not only doing it on a week-by-week basis, they're doing it on an hour-by-hour basis. So this will turn out to be a complete nothing burger in another 3 months or 4 months when Tesla is just changing their prices all the time, unlike other car companies. But they're able to do it because of the data they're getting. They're getting real-time data on their website, specifically showing them whether people are buying based on current pricing or leaving the website. If too many leave the website, it tells them they may need to make a price adjustment. If people are buying and everybody's buying, and then you start to see the lead time stretch out, or you start to see local inventories dropping, then that tells them they may be able to raise 1,000 or 2 or 3. So they have information that nobody in the automobile industry has but them, and it allows them to maximize their return on investment, their return on every single car based on conditions on the ground, and also maximize the total amount of cars that they ship. So that's what you want them to do as an investor. That's what you want to do as a fan. That is great management as far as I'm concerned. All right, so let's see here. So that would be the main thing that you should be watching with Tesla. What's going to push the stock down or up is probably going to be all that kind of stuff for now. Right now, it's going to be if they raise prices, if they lower prices, the prices might go up or down a little bit. But as I said on my show on Wednesday, I believe it was, what you can continue to expect is that Tesla is going to continue to march along with the macro. They've already had their big drop because of the earnings report. That's over. Yeah, sure. There might be another bad day somewhere along the line because people are reminded or something. I'm not sure. But really, over the next, until the next earnings report, or until the next major announcement, or until there's a new car that comes out, or something that really could move the market, which would be unlikely in this market, watch the macro or watch the Randy Kirk index. If you don't know what the Randy Kirk index is, go back and look at my, I think my Wednesday show, or it might have been my Monday show, where I talk about the Randy Kirk index. I also post it every day on Twitter, which is the what I call the risky growth stock index, a bunch of ARK Invest type plays. By the way, ARK Invest came out with their report. You might want to look for that. And they said that they see Tesla at a minimum of 2,000 by 2027. That's their kind of their base case. It might even be their, I can't remember if it's a bear or base, but 2,000 is their number. And that did not include, Optimus, did not include any significant energy storage, did not include anything on semi. So the 2,000 number to me is way low. And my number, of course, is higher than that. So the Tesla will continue to march along, as I say, for now, right around the macro. I think it will trend up towards next quarter's earning. It'll trend up back into that 185 to 214 range. I don't expect it to break out of that range until the next quarter, because the next quarter it'll be needed to show what is the effect of this new pricing and pricing strategy. Is it moving all the metal? And is it moving all the metal at margins that are acceptable to the street, or at least expected by the street? And I think we'll see that that is true as their costs go down and they're able to potentially maybe start moving some of the retails up. That's all I got for you today. Check out all the videos coming up this week. I think that you'll find a number of them are extremely useful. Be sure to like, be sure to subscribe, be sure to hit notify, because I'm now giving you information in advance. If you look down in the information below, you'll see I'm giving you information in advance about what shows are coming up. And if you hit notified, then you'll be notified that so you don't miss them. And then, of course, could use the support on Patreon, only $5 a month. Go ahead and take a shot at Patreon. It's been great talking to you.